Hi there, this is Bob Graham with Riggs Asset Management Company. Today we're going to continue the conversation about what we see coming down the road for 2026. As we said before, we think it's going to be a good year. We think it's going to be a bumpy year. Much like last year, we think the markets are going to be 2 steps forward, 1 step back, but overall, we're really optimistic about what we see. So we talked about some of the tailwinds in a video. We said we thought that the changes in the tax law were going to benefit both households and corporations, and that was going to benefit the overall economy and would bleed into the markets. Part 2 of that is where we are in the interest rate cycle and what we see coming down the road. So we're going to talk about interest rates, inflation, a little bit about the housing market, and where we see the Federal Reserve moving as we go through the year. So as you know from previous videos, we pay close attention to what is happening to the 2-year Treasury. And the reason being is, historically, the 2-year Treasury has led the Federal Reserve. And right now, the 2-year Treasury is saying the Federal Reserve is likely to cut interest rates 1 to 2 more times this year. But what's interesting is the 2-year Treasury is now at the lowest point we've seen it in 3 years. And if it breaks below this level, and I'll put the chart up here, you can see the 2-year Treasury with the Fed funds rate, and you can see how they follow each other. It looks like the 2-year Treasury is moving down. And by the way, when we look at other yields across the market, so let's say the 30-year mortgage rate, it's been bouncing along that 6%, and quite frankly, looks like it wants to come lower. We're seeing 10-year Treasury yields come down. Essentially what we're seeing is the yield complex across the market is moving lower. Well, why is that? Well, one of the reasons is inflation. And I know it's a really hot topic right now with inflation, but I just want to focus on one component of inflation, and that's shelter. So without getting too wonky, shelter represents 36% of the entire CPI number. So, and what we are seeing is that when we look at existing home sales and their prices, over the last year, existing home sales are only up a little bit less than 1%. In fact, we've been seeing the rate of growth in home sales prices come down. I'll say that again. Home sale prices have been moderating as we've looked at, let's say, the last 3 years. The interesting thing is new home sales, which are also part of the shelter component, are actually negative. You're actually seeing new builds prices being cut. And on top of that, you have rent, which is another component of shelter. And we're seeing rent prices come down. The point being very simply, if you have over 1/3 of any index flat to moving down, it's really hard for that index to move higher. So if the Federal Reserve is going to follow inflation, if the Federal Reserve is going to follow the 2-year Treasury like it has, we expect to see interest rates continue to moderate as we go through this year. So what does that mean? I think you're going to be looking at mortgage rates with a 5 handle. And probably by the end of the year, maybe as low as 5.5. That's really going to open up the opportunity for buyers in the housing market as we move forward. When you're talking about shelter trends, one of the things you have to remember is that, they tend to be slow. People don't sell their house every year. People don't buy a new house every year. So what you see is a very gradual movement in these trends. What it means is we're likely to see pressure on the consumer price index for the next several years. So as we look at the overall economy, as we look at the overall market, what we see is an economy that is going to be growing because of demand driven by the AI build out, by general reshoring, and just an expansion of the economy from changes in the tax law. We're seeing consumer price index that's going to continue to moderate because the largest component of that index is quite frankly going to be flattish probably for the next 2 to 3 years. And when we look at just what leads the Federal Reserve, the 2-year Treasury, we're seeing the 2-year Treasury say, hey, it thinks, or the market thinks, interest rates are going lower, the Fed will tend to follow. So we think we get a couple of interest rate cuts this year. We think interest rates are going to be lower, mortgage rates are going to be lower, and this should benefit consumers and businesses across the board. We view this as another tailwind for the U.S. economy. Anyway, if you have questions about this video or anything else, whether it's a personal financial question, a business financial question, or what's going on with the markets, give us a call. We're here to help you in any way we can. Thank you.